Welcome to Crisis and Consequence. Thank you for being with us here today. Let's get right to it. Today, we're unpacking the historic $3,030 milestone of gold in global markets. The recent surge in gold prices beyond the $3,030 mark represents a watershed moment in financial markets, embodying complex economic forces, geopolitical tensions, and centuries of human fascination with this precious metal. This comprehensive exploration delves into the factors driving gold's remarkable rally, its historical significance, and what investors might consider in today's uncertain economic landscape. Gold has shattered previous price records, reaching an unprecedented high of $3,038 per ounce on Tuesday, March 18, 2025. This remarkable achievement represents a 15% increase since the beginning of the year, continuing the precious metal's strong performance trajectory that began in early 2024. Several immediate catalysts have propelled gold to these historic heights. Primary among these is the looming implementation of President Trump's reciprocal tariffs scheduled for April 2, which has introduced significant uncertainty into global markets. Additionally, traders are closely monitoring the Federal Reserve's monetary policy decisions, with the central bank expected to maintain current interest rates while potentially signaling future cuts. Geopolitical tensions continue to provide strong support for gold prices. The Middle East conflict has intensified, with Israeli strikes reportedly killing over 400 people in Gaza, threatening a fragile two-month ceasefire. Meanwhile, diplomatic exchanges between President Trump and Russian President Putin have resulted in a tentative 30-day halt on attacks targeting Ukrainian energy infrastructure, providing slight market relief while underscoring the persistent geopolitical instability that typically benefits gold. This extraordinary price surge has exceeded previous expert projections. Goldman Sachs Research, which had earlier forecast gold reaching $2,890 by year-end, recently revised their outlook upward to $3,100 per troy ounce by the conclusion of 2025, suggesting an additional 8% growth potential from current levels. To understand gold's enduring value proposition, we must appreciate its remarkable journey through human civilization. Gold's relationship with humanity dates back millennia, with archaeological evidence confirming it was first smelted in ancient Egypt around 3600 BC. By 2600 BC, Egyptian hieroglyphs described gold as being more plentiful than dirt, while the earliest known map from this period actually depicts the plan of a gold mine. The metal's cultural significance was cemented through artifacts like Tutankhamun's funeral mask, crafted around 1223 BC, demonstrating gold's early association with divinity, power, and immortality. However, gold's monetary role began in earnest around 600 BC when the first gold coins were struck in Lydia, Asia Minor. These early coins were initially a crude mixture of gold and silver, but by 560 BC, the Lydians had mastered metal refining, creating the world's first standardized bimetallic coinage system known as crosids after their king Croesus. This innovation marked a pivotal moment in economic history. The consistent gold content of these coins established them as the first widely accepted form of currency traded with confidence across different regions. When Persia conquered Lydia in 546 BC, they adopted gold as their primary coinage metal, further spreading its monetary influence. By 500 AD, the ancient Chinese state of Chu was circulating the Wang Yuan, a square gold coin, demonstrating the metal's cross-cultural monetary value. Medieval Europe saw further formalization of gold's economic role, with the establishment of hallmarking at Goldsmiths' Hall in London in 1300, creating standards for gold purity that enhanced trust in gold commerce. Between 1370 and 1420, European gold mining became so intensive that many mines were nearly depleted, causing what historians call the Great Bullion Famine. The first gold sovereign, a coin that would become iconic in British monetary history, was struck in 1489 under King Henry VII. By 1717, the United Kingdom had established the gold standard, formally linking currency to gold at a fixed rate and creating a monetary system that would eventually spread globally. The Industrial Revolution transformed money production when steam-powered coining presses designed by Matthew Boulton and James Watt revolutionized the efficiency of minting operations. This technological advance coincided with the Royal Mint's relocation from the Tower of London to Tower Hill, marking the modernization of currency production. The California Gold Rush of 1848, triggered by James W. Marshall's discovery at Sutter's Mill in Coloma, dramatically increased global gold supply while accelerating America's westward expansion. Between 1870 and 1900, virtually all countries except China adopted the gold standard, creating an interconnected global monetary system based on gold convertibility. The 20th century witnessed profound transformations in gold's relationship with the global monetary system. World War I forced many nations to adopt fractional gold standards, effectively inflating their currencies to finance military expenditures. The interwar period saw attempts to restore the gold standard, but the Great Depression ultimately led many countries to abandon it in search of monetary policy flexibility. The Bretton Woods Agreement of 1944 established a modified gold standard system where the US dollar was pegged to gold at $35 per ounce, with other currencies pegged to the dollar. This system created relative stability in the post-war era, but ultimately collapsed in 1971 when President Nixon suspended dollar convertibility to gold, initiating the era of freely floating fiat currencies we know today. This transition marked the beginning of the modern gold market. Released from its fixed monetary role, gold began trading as a market-determined asset. Since the end of the Bretton Woods system in 1971, gold has achieved an impressive annualized growth rate of 8.1%, demonstrating its long-term appreciation despite periods of volatility. Government policies exert profound influence on gold prices through several key mechanisms: monetary policy and interest rates. Central bank monetary policy, particularly interest rate decisions, significantly impacts gold prices. When interest rates are low, the opportunity cost of holding non-yielding assets like gold diminishes, enhancing gold's attractiveness as an investment. Conversely, when interest rates rise, the relative appeal of interest-bearing assets increases, potentially reducing demand for gold. This relationship explains why market participants closely monitor Federal Reserve decisions. Currently, according to the CME Group's FedWatch tool, traders expect the Fed to maintain current interest rates at their March 19 meeting, while anticipating a potential rate cut in June with nearly 66% probability. Such monetary easing would likely provide further support for gold prices. Government fiscal decisions, including spending policies and taxation, also substantially influence gold markets. During economic uncertainty or recession, governments typically implement expansionary fiscal measures, increase spending and tax cuts to stimulate economic activity. These actions often raise inflationary concerns, driving investors toward gold as an inflation hedge. The massive stimulus programs implemented during recent economic challenges have dramatically increased government debt levels globally. This debt expansion raises concerns about potential currency devaluation, further enhancing gold's appeal as a store of value independent of government monetary systems. Modern central banking has introduced unprecedented monetary expansion through quantitative easing key programs. Following the 2008 financial crisis and again during the COVID-19 pandemic, central banks purchased vast quantities of financial assets to inject liquidity into markets, dramatically expanding their balance sheets. These policies have significantly influenced gold prices. During the first major QE programs between 2008 and 2011, gold prices more than doubled from approximately $800 to over $1,900 per ounce. Similarly, the pandemic-era stimulus contributed to gold breaking the $2,000 barrier in 2020, with an NPR report noting, "Gold has soared nearly 30% this year." Gold usually rises alongside investors' uncertainty in the economy. It's a safe haven for investors who want to hedge their bets against a falling dollar and instability in financial markets. Another crucial governmental influence comes through central bank gold buying patterns. After decades as net sellers, central banks became net purchasers of gold following the 2008 financial crisis, a trend that has accelerated significantly in recent years. Goldman Sachs research attributes part of gold's current strength to higher-than-expected demand for gold from central banks, which have been increasing their reserves of the commodity since the freezing of Russian central bank assets in 2022, following Russia's invasion of Ukraine. This shift reflects growing concerns about traditional reserve asset security, particularly when geopolitical conflicts can result in sanctions or asset freezes. Investment professionals consistently highlight gold's unique portfolio attributes in today's economic environment. Financial advisors generally recommend allocating between 5% and 10% of an investment portfolio to gold and other precious metals. This modest allocation provides diversification benefits without overexposing investors to a single asset class. Robert Moon, managing director at Rockefeller Capital Management, advises. Investors should always diversify gold assets, a simple arrow in a quiver of exposure to other tangible materials. He cautions against excessive concentration, noting that outsized bets in any portfolio will lead to regrets. Gold offers several distinctive advantages as part of a diversified investment strategy. Enhanced portfolio diversification. Gold maintains a low correlation with traditional assets like stocks and bonds, typically averaging around 0.1, meaning it often moves independently of these investments. Effective protection against extreme market events. Gold frequently performs well during market crises or tail risk events that negatively impact conventional investments. Superior liquidity characteristics. Gold's market liquidity exceeds that of many government bonds and even the most actively traded stocks, ensuring relatively easy buying and selling with minimal price impact. Inflation protection. Historically, gold has maintained its purchasing power during periods of elevated inflation, serving as a hedge against currency devaluation. Currency diversification. Gold typically exhibits negative correlation with fiat currencies, particularly during currency crises or devaluation periods. These characteristics make gold especially valuable in the current economic landscape, where inflation concerns, geopolitical tensions, and monetary policy uncertainty dominate market sentiment. Investors have multiple options for adding gold exposure to their portfolios, each with distinct advantages. Physical ownership through coins, bars, or bullion provides direct exposure without counterparty risk. However, this approach requires secure storage solutions and typically involves higher transaction costs through dealer premiums. Popular options include American Eagles, Canadian Maple Leafs, South African Krugerrands, and various sizes of gold bars from reputable refiners. Exchange-traded funds, ETFs, and mutual funds offer convenient, cost-effective exposure to gold prices without physical storage concerns. Funds like SPDR Gold Shares, GLD, and iShares Gold Trust I hold physical gold backing their shares, providing price performance closely tracking the underlying metal with high liquidity and relatively low expense ratios. Stocks of gold mining companies offer potential leverage to gold price movements, but introduce company-specific operational risks, as John R. Gilbert of investment firm Bradley, Foster, and Sargent cautions. Most investors should avoid highly volatile vehicles such as exploration stocks. Larger, established producers generally provide more stable exposure than junior miners or exploration companies. Sophisticated investors might utilize gold futures or options contracts for leveraged exposure or hedging strategies. However, these derivatives require advanced market knowledge and involve higher risk profiles unsuitable for most retail investors. For the majority of individuals, a combination of gold ETFs for liquidity and convenience, supplemented with modest physical holdings for direct ownership, represents the most balanced approach to gold investment. Goldman Sachs Research recently revised their gold price forecast upward to $3,100 per troy ounce by the end of 2025, suggesting an additional 8% increase from current levels. This projection rests on several fundamental factors. Sustained central bank demand. The trend of central banks increasing their gold reserves appears structural rather than cyclical, particularly following the 2022 freezing of Russian central bank assets that highlighted sovereignty risks in traditional reserve assets. Growing investment interest. As interest rates potentially decline, Goldman Sachs Research anticipates increased investment through gold ETFs, providing further price support, potential moderating factors. The analysis does note that speculative positioning in futures markets has reached elevated levels, potentially limiting short-term upside as traders adjust positions. The combination of persistent geopolitical uncertainties, anticipated monetary easing, and strong institutional demand suggests continued support for gold prices, even after the remarkable gains already realized. For those contemplating gold investment in the current environment, several strategic principles merit consideration. Rather than attempting to time market entry perfectly, experts typically recommend establishing gold positions gradually through dollar-cost averaging. This approach mitigates timing risk while building exposure over time. Investors should clarify their primary objective for gold investment, whether inflation protection, portfolio diversification, crisis hedging, or speculation, as this influences appropriate allocation size and investment vehicle selection. Gold should represent one component within a broader diversification strategy that might include inflation-protected securities, commodities, real estate, and other alternative assets depending on individual circumstances and goals. Transaction costs significantly impact long-term returns, particularly for physical gold purchases where dealer premiums can exceed 5% of the metal's value. ETFs typically offer more cost-effective exposure for larger allocations. So in conclusion, gold's historic price surge beyond $3,030 represents more than a market milestone. It reflects the complex interplay of economic uncertainty, geopolitical instability, and monetary evolution that continues to affirm gold's unique position in the global financial landscape. From ancient Egyptian mines to modern investment portfolios, gold's journey through human civilization demonstrates its remarkable adaptability. Whether as currency, jewelry, industrial input, or financial asset, gold has consistently retained value across civilizations and through economic transformations. In today's environment of elevated government debt, monetary experimentation, and geopolitical fragmentation, gold's traditional role as a store of value independent of any single government's policies resonates with investors seeking portfolio resilience. While past performance never guarantees future results, gold's demonstrated capacity to preserve purchasing power through periods of economic turbulence suggests its continued relevance in thoughtfully constructed investment strategies. For those considering gold investment, the key takeaway from market experts remains balance, incorporating gold as one component within a diversified portfolio suited to individual circumstances and objectives rather than making outsized allocations to any single asset class. As we continue navigating this complex economic landscape, gold's performance will remain an important barometer of global financial confidence and monetary stability.